A large uptrend is reversed by a series of patterns. First, there is the gap up. This extends the lower boundary of a less strict triple top that, like many examples, sees a strict double top aligned with a single downswing. This first formation is completed quickly with a gap down. After immediately recovering in July, another strict double top reused the gap up level as its upper boundary. From these patterns, there are clear declines, with downswing points to add to the bearish context. The descending channels and trend lines provide helpful guides in determining areas where the recovering uptrend could encounter stronger resistance. A strict double bottom forms and presents a clear uptrend line to approximately identify when trading moves neutral after it is breached. Interestingly, the double bottom is in more of a continuation context, since it overlaps with the lower 80s range. That had been the site of several major patterns in the recent past. After failing to stabilize from the bullish overextension following the February peak, KHC continues on the neutral to increasingly bearish path, to eventually fall into a steepened drop from the 91 level. Sustained selling pressure is adequate to breach the double bottom range and move back into the 70s. After the decisive break and persisting resistance around the 80 level, it is helpful to adjust the downtrend lines to accommodate recent downswings and the greater bearish acceleration. There was indeed a descending triangle for a strong bearish continuation to conclusively fall under 80. However, it was more difficult to identify during its formation. This is mainly due to the wider base, extending from the clear 7730 level to the less apparent upswing around 7530 from late October. Interestingly, one of the original descending trend lines retains influence and marks the approximate upper range of an ascending triangle outline in more of a bullish reversal context rather than a bullish continuation. In fact, the old descending trend line is the center of a reverse head and shoulders neckline that shares the same moderate to steep decline. In the long-term context, the overwhelming bearish context is accelerated, with the main gap down that starts 2019. A small upswing at the tail end of August marks plenty of progress as a clear incline develops during the formation of a regular bullish continuation, with general three methods rising price action on a large scale. Interestingly, the gap up is filled starting from the gap fill candle's low at 29.49 to produce an immediate downswing. This is less common since a downswing normally forms closer to the real body of the gap fill candle. However, this is sensible given the long-term bearish context with selling pressure more abundant to counter any upswings. There is a prompt pause at the 3320 level, which forms the wider gap fill zone due to being a round number near the high of the downswing just before the gap down formed in August. 3010 is also a precise level. For further detail, that just happened to be a prior gap up open level, and close to the opening price of the final bullish spike in October. Naturally, there is strong support potential from the 30 to 29 range, due to the intersection of the uptrend line. As usual, a larger drop is only conclusive after the chart firmly closes under the support boundary, which is 29.49 in this case. The brief pause from volatility at 29 seems quick in hindsight. But during the wait in the short term, the few days in February would have seemed quite long and uncertain. prior to the decisive break that was actually part of a shallower descending triangle. March ends with more intense short-term volatility, but the general outline of an inclined double bottom is visible and provides useful uptrend lines to reference. Interestingly, there is accurate identification of the 30 to 29 region presenting stronger resistance in May, due to the influence of the descending triangle's base. In addition, there is the older long-term descending trend line and the natural neutral to bearish price action that follows the breaking of an uptrend line. The same 30 boundary now becomes a key support after a few pivotal bullish spikes gradually surpass the stronger resistance area. To end May, the main pattern of relevance is now a double top, centering on the 3320 level. The double top is being delayed for an extended time, leading to greater chances of it failing to complete. Although the current large green candle has relatively low volume, a bullish continuation to break over 3320 is possible if a rapid influx of bullish sentiment emerges soon with a magnitude similar to the bullish spikes in early June. There is indeed a bullish spike to surpass 3320, but it is only of moderate strength and it is not built upon to reach for the upper descending trend line. With this current bearish spike, the 3320 area now becomes a key support with additional strength, due to the inclined double bottom trend line starting to intersect. Interestingly, the 3320 area is breached with a characteristic bearish spike from the completion of bearish reversal ranges. While there was the outline of a general head and shoulders pattern, it would have been difficult to identify during its formation, due to the many small upswings within it. Additionally, volatility and the roll reversal of the failed double top boundary at 3320 extended the neckline range quite wide. The head and shoulders certainly didn't fail, but the aforementioned factors detracted from its ease of use for identifying the impending bearish acceleration back in August.